Today, this discussion is about Blockbuster and extracting lessons in a business failure. We know that history is filled with companies that have faded into obscurity despite their earlier dominance. Few stories are as stark a reminder of the perils of complacency and a failure to adapt as that of Blockbuster. Once the undisputed king of home video rentals, with thousands of stores and a cultural ubiquity, Blockbuster's empire crumbled largely due to its rigid adherence to an outdated business model in the face of disruptive innovation. Founded in 1985, Blockbuster quickly capitalized on the growing popularity of VHS and later DVD rentals. Its strategy was simple but effective: vast inventories of convenient neighborhood locations and a focus on customer service. By the early 2000s, Blockbuster had 9,000 stores worldwide with tens of thousands of employees. For many, a Friday night ritual involved a trip to Blockbuster to browse the aisles, pick up entertainment for the evening in the form of a VCR cassette tape. However, beneath this veneer of success, a seismic shift was occurring in consumer behavior and technology. The internet was gaining traction, and with it, new ways to deliver entertainment were coming out of that. Blockbuster's downfall wasn't due to a single misstep, of course, but rather a confluence of critical failures. First off, on those was a failure to embrace digital transformation and a missed opportunity along with that. This is arguably the most significant factor. In 2000, a fledgling company called Netflix, then primarily a DVD by mail service, approached Blockbuster with an offer to sell for a mere $50 million. Blockbuster's then CEO reportedly scoffed at the idea, deeming it to be a very small niche business and dismissible. The decision proved to be, of course, a catastrophic miscalculation for Blockbuster. While they clung to their brick and mortar model, Netflix was already envisioning and investing in a future of streaming. So another missed opportunity or failure was its own rigid business model and lack of adaptability. Blockbuster's entire infrastructure was built around physical stores, inventory management, and late fees. There'll be more on this later. This model, while lucrative for a time, became a liability as consumer preferences shifted towards convenience and on-demand access. The company at this point was deeply invested in its existing assets, making it difficult for the company to pivot to any other business model. The revenue relied highly on late fees, a practice that became increasingly unpopular, if you can imagine that, and easily avoidable through subscription models. So I think another key point is that they underestimated the competition and market trends. So Blockbuster dismissed Netflix and later other streaming services as minor threats. They failed to truly understand the disruptive potential of these new players and the underlying consumer desire for greater flexibility and lower costs and not having to pay late fees. So instead of innovating and integrating new technologies, they reacted too slowly and defensively, trying to mimic Netflix's model like their own DVD by mail service, but only after losing significant market share. They were also heavily into debt and had some poor financial management, and well, certainly not the sole cause, but their financial situation was growing increasingly precarious, particularly after being acquired by Viacom and then by an investment firm. The debt itself limited their flexibility to invest heavily in new technologies or business model changes. There was also arguably a focus on short-term profits over the long-term vision, and this reliance on late fees and the initial dismissal of emerging technologies suggested a management team heavily focused on maximizing immediate profits rather than envisioning and investing in the company's long-term sustainability. So there are some lessons learned. I think the Ghost of Blockbuster offers some very useful insights for businesses, and that it's important to embrace continuous innovation and digital transformation. So in terms of R&D, companies must not wait for competitors to innovate. They must be investing in research and development to look after future trends and explore new technologies that could disrupt even the basic core revenue stream of a business. They need to experiment with new business models and technologies and customer experiences on a smaller scale and learn from these pilot programs and be willing to iterate and pivot quickly upon their success. Also, it's important for any company to foster an innovation culture to encourage all employees at all levels to identify opportunities for improvement and disruption, and that culturally the company reward creative thinking and calculated risk taking. So I think another category is to prioritize market research and customer needs. Then listen actively, regularly gather feedback from customers, understanding their evolving needs and pain points and even their preferences, not just to assume that what they want that they will ask. And of course, look very closely at competitors, keeping a close eye not only on direct competitors, but also on startups and companies in similar industries that could potentially disrupt long-standing markets, including the core business. Along with that, it's important to analyze market trends, to keep on the lookout for technological, social, and economic trends that could impact business, and use predictive analytics where the data is sufficient. I think another key lesson is here on healthy financial management and managing debt wisely, avoiding excessive debt that could restrict business ability to invest or to weather economic downturns. Cash, cash is king. That we see that lesson over and over again. So healthy cash flow is absolutely critical, and that can certainly impact the success or failure of any business over the long run. And culture of learning and openness, I think, is a key point here as well. Learning from failures, which are opportunities rather than necessarily having to be terminal events. Conducting post-mortems on a regular basis with staff is also a key part of that. And having open communication to encourage employees to be able to speak up with new ideas and as they may identify potential threats along the way to be discussed and to understand what might be the reaction to these potential threats. So Blockbuster's demise is certainly a powerful testament to the fact that even dominant companies are not immune to failure if they fail to innovate and to adapt and to prioritize the evolving needs of their customers. The ability to anticipate, react, and even lead disruption is not a luxury for sustainable business over the long run, but rather a fundamental requirement for long-term business sustainability. So with that, there are three key questions that a business management team can ask themselves to avoid making the same mistakes as Blockbuster or many other similar companies who have seen the same fate. First of all, is the question, are we actively investing in research and development to anticipate future trends and explore new technologies? So this question is posed to ensure that the management is looking out for changes that could disrupt the core business or to make sure that the team is not too focused on short-term profits and on sweating its assets. Second key question is, do we have a robust process for listening to customer feedback and monitoring competitors? This consideration includes potential disruptors and startups, always keeping an eye on the market and ensuring there is no underestimation of new players and market shifts. And another key question is to ask, is our business model flexible and adaptable? Quite a basic question, but alternatively, the question is it too rigid? Is the business heavily reliant on a single revenue stream, such as late fees? Or are there other areas that could be a future liability? So along with that, I think businesses must continually ensure that its financial situation is healthy enough to allow for significant investment in new technologies and business changes. So with that in mind, thanks for your time, and would be great to hear any further thoughts or feedback that you might have down in the comments section, and hope you like this video. And with that, have a great day ahead. All the best.